Hello, everyone. Welcome back to Financial News in Palos Heights. I'm Ron Jankowski with Channel 4. And, of course, we have, again, Paul Munichel from Ameriprise Financial. Paul, give us an update and what happened.
Thanks, Ron. I've got some interesting tidbits on 2019 for the viewers. So, did you know 2 stocks, and that's right, just 2 stocks last year accounted for nearly half of the S&P 500's total return in 2019. Crazy to believe, but it's true. The S&P 500 produced a strong return of 31.5% in 2019. Now, much has been made, however, of the somewhat concentrated nature of the returns. According to the Wall Street Journal, and it's based on information from the S&P 500 and the Dow Jones Industries, Apple and Microsoft accounted for 15 points of the S&P 500's total 31.5% return. So pretty darn close to half of the return from just Microsoft and Apple. Now, no doubt, 2 companies each had a very good year. On a total return basis, shares of Apple were close to 89% higher, while Microsoft was up nearly 58%. Their contribution to the S&P 500 index was further boosted by their weighting in the market cap weighted S&P 500. And for those viewers that need some clarification on that, the S&P 500, the 500 stocks that make up the index, are not all equally weighted. So Apple and Microsoft do have a higher weighting in that index, which does account for the return percentage of nearly half. Apple is currently the largest weighted in the index at 4.79%, while Microsoft is second at 4.61%. As a result, the rise in Apple shares contributed to 8.5 percentage points to the S&P 500's gain, while Microsoft added 6.5 points. As we all know, however, statistics can be a funny thing and can often cloud perceptions. Case in point, the Russell 2000 and the mid-cap indexes also produced strong returns in 2019. The small-cap orientated Russell 2000 was up 25.5% on a total return basis last year, while the Russell mid-cap index was higher by 30.5%, both without the aid of Apple or Microsoft. So everyone wants to know, where do we go from here in 2020? The Ameriprise Global Asset Allocation Committee currently sees market valuations as elevated, though possibly not overvalued yet. As a current PE of 21.8%, according to FactSet, the current trailing PE multiple is above its long-term averages, but today's very low interest rate environment often supports higher multiples. Investors are also clearly expecting a strong rebound in corporate profits in 2020 and positive fundamental developments to continue on various trade fronts, including China, which we so often talk about, USMCA, and Brexit. Either way, valuations currently favor a rather optimistic view for 2020 stock market returns.
And morning notes that we have received this morning from Ameriprise Financial, today being January 21st, 2020. S&P 500 index futures are lower this morning as investors assess the potential implications of the respiratory virus outbreak in China. Unbelievable that things are that scary with respiratory viruses.
Well, the expression used to be, and no pun intended here, was they sneeze in China and we get a cold here, because we're such a global economy now, we're all related. I think the impeachment has something to do with it too. There's more than just that why the S&P's down today, but we'll wait and see.
Okay. Stocks in Asia were, excuse me again, stocks in Asia were led lower by Hong Kong's equity market after Moody's cut in its credit rating for the city. Any comments there, Paul?
I think that speaks for itself. You know, a credit cut rate can affect stock markets and oftentimes does.
Yeah, it does. Treasury yields are lower this morning, with the 10-year falling to 1.8%, while the 30-year moved below 2.25%.
It seems in line with a falling stock market today.
Right, and shares of the Swiss lender UBS Group are trading lower in Europe after the break cut its 2020 outlook. And there are no comments from you on that one?
No.
Okay, I'm going to go into the year-to-date. S&P 500 year-to-date is a plus 3.14%. The Dow Jones is a plus 2.92%. And the NASDAQ Composite year-to-date is a 4.67%. Things are strong.
We're off to a good start again.
If we can only maintain it, but we're always expecting this slight correction, and that's good for the market.
Yeah, I mean, that's the question we got all of last year, and it's continuing into this year, is when does that pullback or correction come? We don't know. At some point in time it will come, but right now the fundamentals underlying the market still look strong, and it can keep going.
All right, well, that's it for financial news this morning. We're going to be switching to Your Money. Stay with us, and Paul is going to be talking about qualified charitable distributions, something that you should be concerned about on taxes. Stay with us. We'll be right back. Thanks for staying with us. We are back with a show called Your Money, and Paul is going to be talking about tax smart giving. And Paul, I'm going to let you give a little preamble on that.
Thanks, Ron. We're talking about qualified charitable distributions in this show today. So we're going to refer to them as QCDs, just so you know what we're talking about. So you're thinking about making a large financial gift to a charity, or potentially looking for ways to reduce your taxes. If you're retired and have IRA assets, the qualified charitable donation, the QCD rule, might work in your favor. The QCD rule allows for IRA owners, or those who have inherited an IRA, to exempt their required minimum distributions from taxation through direct charitable giving. It's especially pertinent given recent tightening rules on itemized deductions. So let's talk a little about QCDs, and hopefully we can answer your questions.
All right, we'll start out with Paul. Who qualifies to make a QCD?
Good question. Age requirements for RMDs and QCDs are very similar, but not exactly the same. IRA owners become eligible for RMDs anytime during the year in which they turn 72 years old. For a QCD rule to be in effect, you must have reached the age of 70 and a half years of age. It's a very slight distinction, but one that matters when you want to reap the QCD tax benefit in your first year of eligibility.
And meeting the RMD rules with a QCD is different?
Yes. RMDs can be an annoyance for people that don't want to take them, especially when you don't need the money from your IRA. Yet, failing to take RMDs is a costly mistake. The IRS does impose hefty fines on taxpayers who skip this annual obligation. If you can get by without taking income from an IRA, you might want to consider doing good with the dollars you are required to withdraw. That's where the QCD rule can do double duty. The IRS states your qualified charitable distribution can satisfy all or part of the distribution of your RMD in any given IRA distribution year.
Are there any eligible amounts that you should be concerned with?
Yeah, so the QCD rules apply to IRA distributions up to $100,000 annually. The limit applies to the IRA owner and not a household. This means your spouse can also donate up to $100,000 from his or her own IRA through a qualified QCD distribution in the same year.
And then what about timing on this?
Timing does matter. The IRS applies the first dollars out rule to the RMDs from your IRA. That means whatever is withdrawn first from your IRA during the tax year goes toward satisfying the RMD. If you make a withdrawal as income earlier in the year, the withdrawal will reduce your tax exemption under the QCD rule. To get the maximum tax benefit, make sure your QCD is done early in the year before withdrawing funds for any other purpose.
And who could really receive QCDs?
So generally, we look for charities that you'll choose for QCDs. QCDs only apply to charities granted tax-exempt status by the IRS. This generally includes nonprofit groups such as churches, charities, and other 501c3 organizations. When in doubt, visit the IRS online tool to confirm your nonprofit status.
And what about eligible IRAs?
Good question. You can make a QCD from either a traditional or a Roth IRA. However, the tax benefit associated with the QCD rule only applies to traditional IRA owners, since the withdrawals from the Roths are not taxable. Savings held in an employer-sponsored retirement account are not eligible, so consider an IRA rollover if you want to take advantage of the QCD rule in the future.
You really need to share this with your tax preparer in advance, shouldn't you not?
Yep, any regular viewers of our show know we always advise speaking to your tax advisor before taking any action on a QCD or a RMD or anything that involves taxes. Ron and I speak in general tax terms here, but neither of us are tax advisors, so you do need to speak with your tax professional before you take any action.
You know, this is so important that you do at least share this months in advance, if that's what your intention is, with your tax advisor.
Talk with your tax advisor and plan ahead with your financial advisor.
Right.
And this may or may not apply to you at home, but it's just something we like to report to people, that you do have the option of donating directly to charity and potentially save some tax dollars while doing so.
All right. Paul, is there anything else you want to summarize on this?
The only
I think
thing
you
I
did
want
already.
the only thing I want to add is if you've got questions or concerns on this topic or any others, feel free to call me directly at 708-226-3412.
Thank you, Paul, for bringing this to our attention and sharing this with the viewers. For Paul Munichel with Ameriprise Financial, I'm sorry about
It's okay.
chopping that up, Ameriprise Financial. And they are really good about helping us with resources for the information that you do bring into us, and they do share the daily notes to me that I read. They're really good with their resources and sharing that with us. So thank them, Ameriprise Financial, and Paul Munichel, for being here. Myself, Ron Jankowski with Channel 4 and Palos Heights. We wish you good investment day.